morning, everyone. If I may...
Bonjour tout le monde. Bonjour tout le monde.
For the morning in the main plenary session. All right, as that is in progress, I'd like to reintroduce myself. My name is Ramah. I'm a business journalist based in East Africa with bylines at Bloomberg and a few other organizations you might see and hear from every now and then. I'm really looking forward to the conversations we are going to have over the next hour. One of the beauty of being at AFIS is that it brings together not just traditional financial institutions, but it also brings us together with the next wave of institutions that are trying to essentially expand access to financial services, more often than not from the tech world. And we'll be hearing from individuals in the tech world in the panel that will follow after this 20-minute conversation. But what we'll focus on in the next 20 minutes is exclusively on where the capital is coming from to invest in these fintech firms. Where is it coming from? What are the opportunities? What are the risks, especially after the year that we have had, where you've had interest rates rising across the world? And yet, in a continent where so many of us, tens of millions, are still unbanked, there's a clear opportunity, I think, to expand access to financial services and to democratize access to these financial services. For that reason, I'd like to engage in a conversation with Mareme DIENG. Please come up to the stage. A round of applause, please, for Mareme. Mareme, when the team at AFIS initially said, look, we're going to have this conversation and we're going to focus on fintech, we're going to focus on the sources of capital, one of the first things that came up to me was, hang on, who's 500 Global? What is this company? What does it do? So let's start there. What is 500 Global?
So 500 Global is a venture capital firm. We started in the US, where we were leading early stage investments since 2010. And we rapidly grew out of the US because we realized that there was an opportunity to invest in tech in emerging markets. So today, as a firm, we invest in 87 different countries. We have about $3 billion of AUM. And our focus is primarily how do we find these very early stage tech companies and how do we fund them for them to actually become market leaders. And in Africa in particular, we have had the chance to invest in numerous companies. We've done about 100 investments in Africa. We've invested in companies like Cheaper Cash, Stitch, and numerous fintechs. And our focus as a firm is really to provide funding and support to these tech companies and to really be the first one to take risks into their investment.
So, given all the macroeconomic turbulence, and that I think really was a bit of a theme, right? In day one of the conference, we spoke about how rates have really gone up and they're expected to remain pretty elevated in 2023, 2024. You're looking at inflation that's ravaging household expenditure. Nigeria's inflation data came out yesterday. Looks pretty tough. And inflation is not, it's not just a Nigeria problem, it's pretty much up and down the entire continent. Egypt is at 40%, Kenya is at 7%, but household incomes have been in decline for a decade. Given that sort of adverse environment, how are your portfolio companies doing?
It's a great question. And I think that for us as what we called alternative assets, which is I guess what VC would be considered on the continent as well as private equity, our investments are high-risk investments, right? Because we invest so early, and also we tend to be the first institutional capital that really enters a tech company. And so often, we take a high level of risk in basically betting on these companies. And today, because of the type of sectors that we invest in, as a fund, we're sector agnostic, but a lot of our investments, particularly in Africa, have been in fintech, in B2B, in marketplaces, in ed tech, as well as in emerging technology like blockchain and crypto. We have seen that there has been a market correction and that market correction has resulted in markdowns in a lot of portfolio companies that we've seen. However, what we're seeing today, and particularly I would refer to emerging markets like Africa, but also Latin America, Southeast Asia, is that there is a very strong resilience among tech founders. Often what you see in the news is obviously you're hearing about, the companies that are going down, the ones that are going bankrupt, the ones that are not able to fundraise further. But for us, having deep insight into our portfolio companies and what's actually happening behind the door, I can tell you that there is a lot of resilience, particularly among African founders. And a lot of them right now are focusing on how to create more sustainable margins for them on the long term, particularly those that have a very strong segment related to B2C. But also, a lot of our portfolio companies are now finding a way and urging, really, to be able to expand outside of the markets that they are. One of the things that we've realized is a lot of the actually risk you mentioned around inflation and currency is tripled when you are acting in a singular market. And we see that a lot in tech companies, right? Because often they want to become a market leader in Nigeria or in Egypt or in Kenya, which are the dominant markets. But what you see is that in order to be able to actually de-risk your exposure to some of these risks related to currency and inflation, you need to rapidly be active in several markets, whether it be several markets.
Geographical diversification
Exactly.
as a hedge.
100%. So to give an example, we have a portfolio company that was a Nigerian portfolio company acting as well in the fintech B2B marketplace. And very rapidly, one of their areas of expansion was Francophone Africa. And the reason being was related to currency, because the Francophone market had a much more stable currency compared to the devaluation that was happening in Nigeria. And just that alone allowed them to survive an extra 12 months to be able to raise an additional round of capital. So you see very quickly that diversification in geographies is helping some of these companies mitigate some of the risks that they're experiencing. But of course, like I mentioned earlier, we are seeing some of these consequences affect them directly, and some of them are directly suffering from the macroeconomics across the continent.
One of the things that I know we spoke about before, having the conversation when we were trying to figure out, the outlines, right, of this conversation was going back to the 90s and the early 2000s, right, and using the American tech market as an example then. A lot of the dominant tech firms that we're seeing now, your Googles, your Amazons, and so on, essentially the ones that sort of survived the shakeout from the late 90s, the early 2000s. And in some ways, this current period of volatility that we're feeling, that we're going through now, somewhat feels similar. So how will the next wave of fintechs survive this? How do we prime them for survival in this environment?
I mean, something that is quite clear today is that fintech cannot be ignored in the conversation on financial inclusion, because fintech companies are really the ones that can target and address some of the issues that we're seeing at the population level when it comes to them having access to more basically financial services. And what we've seen in the US in previous basically times of basically financial markdown has been that that's when resilient companies come out. And just to be clear, because often people will say, well, the US and Europe are not relatable examples. When we look at, we also have funds in Latin America and Southeast Asia. And those are examples that I truly believe are much better comparable to the continent. And in Latin America and Southeast Asia, what we're also seeing is that times of financial markdowns have created much stronger and more resilient fintech companies, particularly related to that. And, we are seeing that happen as well on the continent today. We've all seen news of, tech companies across the continent that has raised millions of dollars. I guarantee you that the ones that are going to be able to survive the next few years are the ones that will be able to focus, one, on value for customers, and second, that are building the right business fundamentals for the markets that they're actually targeting. And I think that for us, right, this also is a great time to invest. We are not stopping to invest in African tech. We will not. As a matter of fact, we will use this time to double down more, because these are also the type of times where you find founders who are truly committed to the problems that they're solving. I mean, in my home country alone, I'm from Senegal, and in Senegal, we're seeing that the founders who want to build companies now, particularly now, are founders who are really determined to solving the problems that they have identified, but also they are experienced founders, right? They are founders who have failed in their previous businesses and who are coming with experience now to build something of value.
Can we talk about the aspect of failure, especially within the context of the African fintech ecosystem? It's young, it's nascent, and granted, I'm generalizing a ton here, but our societies generally tend to not look at failure as a learning tool, as a learning opportunity. It's, oh, you invested in this company, you tried to build it, it didn't work out. We don't bother to ask, okay, was it a macro issue? Was it management? Was it governance problems? It's just, you failed and that's it. Which I think deprives us of all these lessons that we can learn, right, from all these companies that might not necessarily make it through the shakeout that we're going through now. So from where you sit, right, on the VC side of things, how do we give African entrepreneurs the chance to fail, to learn, and come back stronger in the market?
I think one, to start with, we should look a bit at data. And in this case, I think looking at the US market is a good comparable. So in the US, the startup rate failure is 9-1. So in 10 startups, 9 will fail, 1 will succeed. And so when you, and the US is considered a developed market that have access to resources. So when you try to contextualize that a little bit more into some of our emerging markets, and particularly for us here on the continent, you realize that the acceptance of failure being part of the process is a must in finding these companies. And that doesn't mean, and I think that's what people usually conflate, they think that the acceptance of failure means basically being complacent and means allowing founders to raise millions of dollars and run with that with no accountability. And that allows them to come back and raise even more. And I think it's much more nuanced than that, because when a company fails, we need to spend time understanding why they failed and understanding whether or not it has to do with mistakes done by the founders or possible fraud, or if it actually has to do with mistakes that happen trying to implement a solution in a constantly moving market. And that makes a strong difference, because if we can't learn from the mistakes as to how and why these companies are failing, we basically find ourselves in an endless cycle where we're back in the same position where we were in 20 years. Because the founders who are failing now, especially those who are failing because they're basically being hit by the reality of the market, I guarantee you that most of them, if they start a company again, they will not make the same type of mistakes. And we're better off keeping them here on the continent, motivating them to continue building companies and to use those mistakes and those learnings to do better than losing them to another market because they can no longer have a professional life in the market where they failed.
And that comes down to being able to tell their stories, our stories, in detail, both the good, the bad, the ugly, all of it. Because one of the problems that I know we encounter, at least on the journalism side of the space, is, we'll see all these headline numbers. You raised XYZ in Series A funding, XYZ in Series C funding. But when it comes down to the brass tacks and asking, okay, did this product work? Was it the ideal product fit? Was it necessary for you to essentially, try and blitzscale at this point in time? That's where the stories sort of fall apart, because we don't want to have an open conversation, right, about this worked, this didn't work, and why. So we have to tell our stories better.
I mean, The transparent element of storytelling is critical, right? And I think that the same goes for when you hear a company went bankrupt with absolutely no context of what happened. The same goes if you hear companies raising millions of dollars without understanding anything about what their business model is, what is their target, is their product market fit, what is the volume and increase over time. So I think that a lot of it also comes down to the education that us VCs are doing with our founders to allow them to better tell their stories, and also for them to be part of an ecosystem where there can be transparency. And that is actually a key part of technology. Technology is about transparency. It's about showing people why things work and why they don't, so that we can learn and iterate and improve. And for a lot of our founders, I think this is a time as well for them to be able to basically step up to the plate. And which is why I think that there should be increased collaboration between actors of the financial industry, because when I see and hear that venture capital or private equity are considered to be basically different in their own class than the traditional financial industry, I think that's worrisome. Because the companies that we invest in at the early stage, those companies are the ones that will become the leaders of those sectors in the future. They are also the companies that are going to become potential acquisition and acquisitee for big corporates. So we need to also have better visibility across the chain, and that visibility comes from more collaboration between the different financial sectors actors, because VC and private equity do play a very big part in creating some of these leaders and being able to share data and information about what is happening at our level.
Indeed, and for the audience, to sort of encapsulate some of the things we've been discussing, if you have time later on in between sessions, I'd encourage you to look for one of the more recent blog posts by Jason Joko of Iroko TV, and he's spoken in detail about the sort of challenges that they've had, right, in trying to build that video on demand service, the pivot from being very Nigeria-focused into diversifying and focusing on other markets, in fact, outside Africa. And that sort of geographical diversification is what essentially has helped the company to remain alive. Totally worth reading, 10 out of 10, would recommend. One last question for you, Mareme. You're a tech optimist by default, and yet, from where I sit, I look at some of the macro data coming out of Africa, and there's a lot of things that are flashing red. Currencies are tanking by double digits. Inflation is high in various markets. Household income has been really savaged over the last 5 years. Job losses from the pandemic, we're still sort of working our way through. And capital is becoming a lot more expensive, right, to raise and to deploy. I see a lot of red ink across the board. But you're making the argument that this is a time to be optimistic about tech in Africa. Why?
I mean, all the things that you say, after everything I'm going to say, will sound overly optimist, considering all the conditions that we see right now on the macro side. But I will say this. So 3 things. The first one is any founder who chooses to start a company in the conditions that you've mentioned, so high interest rates, high inflation, currency devaluation. Any founder who tends to want to jump in an entrepreneurial journey during this time are founders that have extreme resilience and who often are building a company not to build wealth, but to build value. That's one. Second reason is because what we're seeing today on the continent is that there is an absolute growing need, considering all of our macro challenges, to create employment. There needs to be more actors coming out from entrepreneurship that can build companies that can employ. And what we know now is that tech can be a big lever for employability, and especially for building high employability skills. So when you're thinking about tech companies as well, I think what we're thinking about as a default is whether or not this company will be a unicorn. but we don't look at the entire process of what they will do in that pursuit, which is build jobs and create value for customers. And then the last thing I will say, and the reason why we are so optimistic, is we started investing in Southeast Asia, Latin America, and the Middle East in 2012. At that time, any company, any venture capital, really, we were the first US venture capital company to aggressively invest in those markets. And at the time, people called us crazy because they looked at, you know, the macros in LATAM, in countries like Brazil and Argentina where we're investing. They looked at the macros in Southeast Asia, in India, Indonesia, and said, it would be insane to believe that you can actually build a portfolio in these markets over the long time. Today, as a US firm, more than half of our unicorn companies come from outside the US. More than half of our unicorn companies, which are the ones that ultimately return, are coming from emerging markets where we have been investing since 2012. So ultimately, what we have to understand and agree with is that this is a long-term game. When you're investing in tech and when you're doing it through an asset like venture capital or even private equity, it is a long-term cycle. And you have to agree that the cycle will come with bumpy roads, but at the same time, you have to ensure that you are present in those markets over a long period enough so that you can have that return. So of course, when we're looking at the macros right now in Africa, it doesn't look like some of those indicators are positive, but I am very optimistic about tech on the continent, and I think that a lot of venture capital firms are looking at this time as the perfect time for us to invest more.
I don't think I can find a better way of wrapping up the session. Mareme, thank you very much for being the tech optimist and the tech evangelist that you are. Ladies and gentlemen, a round of applause for Mareme.